Imagine this. You have the potential to grow your wealth, to see your investments flourish over time. You can achieve financial freedom, breaking free from the constraints of a regular paycheck. This is the allure of stock trading. It offers a path to participate in the market. It's a chance to own a piece of successful companies, to be part of their growth stories. However, this path is not without its challenges. Stock trading can seem complex, filled with jargon and fluctuating numbers. It may even feel intimidating at first, especially for beginners. But fear not, this guide will demystify stock trading for you. We'll take you through each step, ensuring you understand the basics. We'll break down complex concepts into easy-to-understand terms, making the stock market accessible to everyone. By the end, you'll have a solid foundation, equipped with the knowledge to start trading confidently. This will help you navigate the exciting world of stock trading, turning potential confusion into clarity. Let's embark on this journey of financial exploration together. We'll explore strategies, tips, and insights. We'll uncover the secrets of stock trading, revealing the techniques used by successful investors. You'll gain the knowledge to make informed decisions, understanding market trends and news. Remember, knowledge is power. Empower yourself with the tools to potentially achieve your financial goals, using data and analysis to guide your trades. This is your pathway to financial freedom. Let's begin this exciting journey together. Before you dive into stock trading, you need to grasp the basics. Understanding the fundamentals will give you a solid foundation to build upon. Let's demystify the stock market and break it down into simple terms. Think of it like a giant auction, where buyers and sellers come together to trade. Buyers and sellers from around the world come together in this marketplace. They trade pieces of companies, which we call stocks. These stocks represent ownership in a company. When a company wants to raise money for expansion or other projects, it can issue stocks to the public. This process is called an initial public offering, or IPO. It's the first time the company's shares are available to the public. The company then becomes publicly traded on a stock exchange, such as the New York Stock Exchange or NASDAQ. These are platforms where stocks are bought and sold. Investors like yourself buy and sell these stocks, hoping to make a profit. The price of a stock fluctuates based on supply and demand. This means the price can change frequently. If more people want to buy a stock, its price goes up. This is because the demand is higher than the supply. Conversely, if more people want to sell, the price goes down. This happens when the supply exceeds the demand. Understanding this basic principle of supply and demand is crucial for stock trading. It helps you make informed decisions. It forms the foundation of how stock prices move. By grasping this concept, you can better navigate the stock market and make smarter investments. When you buy a stock, you're essentially buying a small ownership stake in that company. You become a shareholder, entitled to a portion of the company's profits and assets. This ownership is represented by the number of shares you own. Stocks offer the potential for growth in two main ways: capital appreciation and dividends. Capital appreciation occurs when the stock's price increases over time, allowing you to sell it for a profit. Dividends, on the other hand, are regular payments made by some companies to their shareholders from their profits. Investing in stocks can be a way to grow your wealth over the long term. However, it's crucial to remember that stock prices can fluctuate. There is always the risk of losing some or all of your investment. Now that you understand the basics of stocks, let's explore the different ways to trade them. Trading stocks can be both exciting and challenging, and knowing the different methods can help you make informed decisions. There are two primary approaches: long-term investing and short-term trading. Each has its own set of strategies, risks, and rewards. Long-term investors typically hold stocks for several years, aiming to benefit from the company's growth over time. This approach requires patience and a deep understanding of the company's fundamentals. They focus on fundamental analysis, which we'll discuss later. This involves evaluating a company's financial health, management team, and market position. Short-term traders engage in more frequent buying and selling, seeking to profit from short-term price fluctuations. This method demands quick decision-making and a keen eye on market trends. They often rely on technical analysis, which we'll also cover. Technical analysis involves studying price charts and using indicators to predict future movements. Choosing the right approach depends on your financial goals, risk tolerance, and time commitment. It's important to assess how much time you can dedicate to monitoring your investments. Long-term investing offers stability and the potential for steady growth. It allows you to ride out market volatility and benefit from compounding returns. Short-term trading involves higher risk but can yield quicker profits. This approach can be rewarding but also requires a solid risk management strategy. Understanding the different trading approaches is vital to developing your own investment strategy. By knowing the pros and cons of each method, you can tailor your approach to suit your personal circumstances. Consider your financial goals and choose the path that aligns best with your objectives. Whether you prefer the stability of long-term investing or the excitement of short-term trading, the key is to stay informed and make decisions that support your financial well-being. You'll often hear the terms bull market and bear market in stock market discussions. These terms describe the overall sentiment and direction of the market. A bull market is characterized by optimism and rising stock prices. Investors are confident and the economy is generally strong. In contrast, a bear market is marked by pessimism and falling stock prices. Investors are fearful and the economy may be slowing down. Market sentiment can significantly impact stock prices. Understanding these cycles can help you make more informed trading decisions. It's important to remember that markets are cyclical. They go through periods of ups and downs. Fundamental analysis is like looking under the hood of a car before you buy it. It involves evaluating a company's financial health, management team, competitive landscape, and industry trends to determine its intrinsic value. Investors use various financial metrics such as earnings per share, EPS, price-to-earnings ratio, PE, and debt-to-equity ratio to assess a company's profitability, growth potential, and financial stability. They also consider qualitative factors like the company's competitive advantages, brand reputation, and management's track record. By understanding a company's fundamentals, investors can make more informed decisions about whether its stock is undervalued or overvalued. Fundamental analysis is a crucial tool for long-term investors seeking to identify companies with strong growth potential. While fundamental analysis focuses on a company's intrinsic value, technical analysis concentrates on its stock's price movements and trading volume. Technical analysts use charts and patterns to identify trends, support and resistance levels, and other indicators that can help predict future price movements. They believe that historical price data can provide insights into future price action. Technical analysis is widely used by short-term traders to time their entry and exit points. Some common technical indicators include moving averages, Bollinger Bands, and the Relative Strength Index, RSI. These tools can help traders identify potential buy or sell signals. Section 8. Risk Management, Safeguarding Your Investments. Stock trading, like any investment, involves risks. Prices can fluctuate, and there's always the potential for losses. Effective risk management is crucial to protect your capital and ensure the longevity of your trading journey. One important risk management strategy is diversification. By spreading your investments across different stocks, sectors, and asset classes, you can reduce the impact of a single stock's poor performance on your overall portfolio. Another key aspect is setting stop-loss orders. These orders automatically sell your stock if it falls to a certain price, limiting your potential losses. Remember, never invest more than you can afford to lose. Stock trading involves risk, and it's essential to approach it with caution. Section 9. The Psychology of Trading, Mastering Your Emotions. Emotions can significantly impact trading decisions, often leading to costly mistakes. Fear and greed are two common emotions that can cloud judgment and lead to irrational decisions. Fear can prevent traders from entering profitable trades or cause them to sell too early. Greed, on the other hand, can lead to overconfidence and taking on excessive risk. Successful traders understand the importance of controlling their emotions. They stick to their trading plan and avoid making impulsive decisions based on fear or greed. Mastering your emotions is just as crucial as mastering technical and fundamental analysis. By developing emotional discipline, you can improve your decision-making and achieve consistent profitability. Section 10. Unlocking Financial Freedom, a Journey of Learning and Discipline. Stock trading can be a rewarding endeavor, offering the potential for financial freedom and achieving your financial goals. However, it's not a get-rich-quick scheme. It requires knowledge, discipline, and a willingness to learn and adapt. Continuously educate yourself about the markets, trading strategies, and risk management techniques. Develop a solid trading plan, stick to it, and avoid emotional decision-making. Remember, patience is key. Successful trading takes time and effort. Embrace the journey of learning and growth, and you'll be well on your way to unlocking the secrets of stock trading and achieving your financial dreams. Section 11. Disclaimer. Proceed with knowledge and caution. The information provided in this essay is for educational purposes only, and should not be considered financial advice. Stock trading involves inherent risks, and you could lose some or all of your investment. Always conduct thorough research, consult with a qualified financial advisor, and carefully consider your financial situation and risk tolerance before making any investment decisions. Remember, knowledge is power, and responsible trading is essential for long-term success.